good afternoon. This is Mr. Not Advice. As always, this is for education and entertainment purposes only. End of the day update for Wednesday, July 22nd, 2026. Well, just another choppy, shitty, crappy day as we entered an 11th straight day of Middle East attacks, which pushed crude to 6 month highs. We had treasury yields being dragged higher. Remember, oil and yields typically move or often move, but typically move in correlation with one another. July rate hike is now back on the table. That I guess could occur fairly quickly if we saw this continued strong move up in oil. Choppy day in stocks today with mega cap tech sliding, and zero DTE traders sold into the Google Tesla print. We had a lotto trade that we will not win money on or make money on today, with Google reporting after hours as well as Tesla. Unless, of course, the market decides in the morning that they did like the CapEx reports out of Google, which they did increase CapEx. But let's get to the overall market today. As I said, oil continues to be pushed up, and that's very pronounced here in the cost of refined products as we have diesel, jet fuel, as well as gasoline, all continuing to trend upwards. CTAs, according to senior commodity strategist at TD Securities, Ryan McKay, CTAs have become modest buyers in Brent crude oil again at prices above $93 a barrel. However, as with every other asset, volatility remains a major constraint. We are seeing some of the pressure, though, come off of oil with the leading indicator of distilled products with the crack spread rolling over today. It actually plunged today. So, well, remains to be seen how the oil market continues to react to the tit for tat that's going on in the Middle East. Getting to the stock market today, Middle East tensions prompted weakness in the futures overnight, but those were erased into the cash open as stocks ripped higher, as traders tried to keep the momentum up from yesterday. But after Europe closed, selling pressure resumed and dragged the major U.S. indices lower. Small caps were the biggest losers today, followed by the Nasdaq with the S&P and the Dow unchanged. Zero DTE traders, as I said, were either selling calls or buying puts, and that created very heavy negative delta flow for pretty much after the lunch hour into the close, and that made it very difficult for the market to get any bullish trend going. Yesterday's big short squeeze that helped drive the market up was completely wiped out today, as well as AI leaders were mixed today with the S&P 500 right here, XAI, pretty much flat for the day. Mega caps, as I said, stumbled today, giving back all the gains from this week. Mag 7 names were mixed ahead of Google's big earnings drop, but overall ended the day lower with the S&P 493 closing unchanged for the day. Semis and momentum did extend gains. They bounced strongly from a weak open, but check writers, which includes Google, continue to be sold this week, while check receivers, microchip companies, have seen a bounce. Bloomberg's Michael Ball points out that while earnings so far have been strong enough to support the higher expectations that are embedded in U.S. equities and healthy profit beats are outweighing softer sales momentum as well as a slowing growth in EPS expectations, 93% of companies reporting thus far have beaten EP estimates by a medium of 7%, while 84% have topped revenue forecasts. Those are not data points that speak to me of a slowdown or a more prolonged drop in the overall market. Yields being higher today are what smashed small caps, because small caps are very sensitive to interest rates because they need to tap the capital markets much more frequently and at a much higher ratio relative to their market cap. Bloomberg also noted that the longer the escalation continues in the Middle East, the more aggressive we're going to see interest rates continue to move up. In fact, the rise in crude prices is being mirrored by the 2-year Treasury, which hit the highest yield since February of 2025. As I stated, the Nasdaq 100 fell as much as 0.8% before recovering a bit, and it's the sensitive Russell 2000 small caps that have sold off even more, which is putting selling pressure on all the small caps that you follow, such as Inventure and PCT, as well as EOSE. If yields go much higher, we're probably going to expect that small caps are going to get smashed even harder temporarily. Bloomberg's Michael McKenzie noted that the 30-year Treasury yield is now trading above 5% for the longest stretch since the beginning of the financial crisis, and that translates into investors are concerned about a growing debt pile among corporations as well as sticky inflation. On the back of that, we have hyperscaler credit risk just hit a new record high. Remember, this is inverse, so risk goes higher for hyperscalers on their debt as this red line continues to drop. Interestingly, Hoisington Investment Management, which is a renowned bond bull trading firm, threw in the towel earlier this month, citing a broader structural backdrop of larger fiscal deficits and higher capital demand that could keep inflation and long end yields higher. What does that mean? Well, as long as hyperscalers continue to need to tap the credit markets, the debt markets, and since the bond buyers for that debt are requiring a higher cost to insure against default, that has the natural effect in investment grade corporate bonds to continue to push yields higher. Bitcoin ETF inflows continued for a sixth straight day, while at the same time, cryptocurrency faded back below that 66,000 level, but that was a modest fade today. And while we all shit on seasonality, one of the things that I found interesting is that Nomura strategist Charlie McElligott, who I think is pretty smart, noted that even though a lot of people think seasonality is garbage, and sometimes it is, this particular market indicator can oftentimes result in a self fulfilling prophecy. How do you take this? Well, this means that we should expect the VIX to start going up right about now, which will be good for our VIX vertical trade. Looking at our individual positions, wheat was able to break out today to a new 52-week high. Intraday high at 26.08 before closing at 25.80. That's very good for our wheat trade. We own December leaps. And while we were underwater, we are still slightly underwater, but with this trend continuing, our next target on wheat is going to be at the 27.50 level here at the 200-day moving average, as well as where this price discovery previously ended on a weekly basis back in September 30th, 2024, with a target above $30. I think that wheat by December is going to end up here north of $32 a share. Our leaps will probably start moving and become profitable once we break through 27.50 to $28. We opened a trade and bull, and tomorrow we're going to have to do a stick save trade. Stick save merely means this. This was the level that was broken. That happened yesterday. We entered this trade today at above 825. And until about midday, the trade was looking very good. And then we had this selling pressure, actually mid morning selling pressure come in, but that's entirely due to small caps being smashed due to rising interest rates. So a stick save means merely this. In order for me to stay in this trade tomorrow morning in the first, let's call it the first 15 to 30 minutes, I need price to get back above 825. We closed at 810, so it's not as if I need a massive move up to continue to stay in this trade. However, today was day one, and I have 2 more days for me to be able to scale and take profits on it. So tomorrow morning, either I get the stick save or I close it out with a 10 to 15% loss. I can live just fine taking 10 to 15% losses with my win ratio being above 60% and my winners averaging 72%. It is always better to take a small loss if your thesis is immediately not panning out instead of giving it time, especially with options. Those members that were able to get into ONDS today, ONDS hit a high today of 858, which I think at that point, within 2 days, my members who got into the trade were up about 80%. EOSE had another weak day today, but it was a very low volume day with only 15 million. 24 million is the average. However, the divergence with the MACD continues to occur as the MACD momentum indicator is about to flip to green. So that tells me sellers are all but exhausted. This, however, with the rights offering might be obscuring the MACD at this point. So we'll have to it remains to be seen. I was looking to enter NVIDIA today. I wanted to close above 214. We closed at 212. You can see right here, this support level or this resistance level. If I can clear this, if price clears this, the next point where I'm going to run into price discovery resistance is all the way north of 232. Now, on the back of Tesla and Google earnings, looking at Tesla right now, Tesla 2374 closed down to 357. And then Google, which disappointed the market at 342 close and 329. We will take probably all of a loss on that all or none lotto trade on the TQQQs. But that's why they were cheap. It was a very small trade. But again, God only knows, as a result of the conference call or as a result of analysts reading the actual report, if they don't flip this market in the morning. I think right now we remain in a very frustrating, very choppy market. It is frustrating. And as I continue to say, and I've said for the past 4 weeks, sitting on your hands and doing nothing is a great plan. So, what do you do in the meantime? What I'm doing is creating a list of stocks, watching for reversals, watching breakouts. Breakouts have been difficult just because momentum flips from strong momentum to negative momentum. There's no in between. We're at the extremes on a momentum basis, sometimes an hour by hour, but certainly on a day-to-day basis. So there's been very little follow through at this point. I will say that earnings have been, as I stated earlier, largely good. Google coming out, obviously at this point, disappointing the market, and they were focusing on their cloud spend and build out. That's going to hit other hyperscalers. So we're probably going to see additional weakness at the open. Truly, the smartest thing, in my opinion, to do during this period is to not overtrade. The market is not supportive of trends at this time. It's very choppy. And unless you're going very far out for your time frame, longer than 90 days, then you're probably going to get chopped up and it's going to be immensely frustrating. Don't be sucked into the siren song that more trading produces better results. That's not how it works. Smarter trading and being patient for the right setups as well as the best market conditions are going to produce the best results. So right now, myself and my members are focusing on our primary goal, which is simply protecting capital. That's all I have today. Hope you're doing well, and I'll see you all in the boardroom.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping.